All right. Welcome everybody to the third quarter global markets and economic update. As you can see in the bottom there, my name is Chris Rawson. This is my colleague, Brian Bly. We host this event every 3 months on the final Wednesday of each new quarter. And this date is very deliberate because it allows us to gather more data as we work through the year. So we have 30 minutes of prepared comments and a number of slides that we will review with you. And we have unscripted Q&A. So this is time for you to have your questions and ask us anything. So we're happy to give you our views and our thoughts and give you that essentially unfiltered response. And so, which is actually a segue to the why. Why do we host this event? Well, for starters, it's because we care. We care about the families that we work for and the people that we serve. And to add a little bit of color to that, and I'll just read this. Our focus is to guide our clients to feel confident in their long-term financial plan and to highlight factual, positive, and negative data points about the global economy. So we live in a time where there's a lot of sort of spin and selective data points that can drive a particular response. And our job, our focus is to not have that selective filtering and actually give you the factual and real good and bad both. So having said that, let me review the agenda with you. In every meeting that we have, whether it be with the folks that we serve or even internally at Vision-Based Planning, we always have an agenda. So here's the agenda. We're going to start with the United States. We're going to highlight the good and the bad, as well as the international developed markets, the international emerging markets. We'll talk about the more conservative parts of the economy, the bonds or the fixed income. Then we're going to be talking about the models themselves that we manage on behalf of the folks that we serve and how we're applying these data points. And then we'll shift to the Q&A. With that in mind, Brian, let me turn it over to you.
All right, thank you, Chris. All right, so we'll go ahead and start here with the U.S., the good. So as far as the U.S. economy goes, we're still doing great. As far as gross domestic product or GDP, we had an uptick in second quarter of 2.8%. So we brought up the year to year over 3.1. As you can see here from this line here, we're right on continuing on the trend growth of 2% year over year since 2001. So all said, the economy is still healthy. We're still doing well. Earnings revisions are being increased by analysts. So there's all signs are pointing to a positive economic outlook for the U.S.
And I guess I'll add my anecdotal comment is when you turn on the news, sometimes you don't hear that. So it's like, again, sorry to just chime in here, but what Brian said is factually true. And that's why we have that chart there to show you the actual data.
So yeah, so from an inflation standpoint, we decreased. We're down to 3.3% as of this past month. So it's held steady over the last really end of last year through this year. We're all have been hanging out around the in between 3.5 mark. So the Fed's increase in interest rates has done its job and brought inflation down to level. One thing to highlight is the red part. Last time we talked about the auto insurance, how that has played a larger part. I think last quarter we talked about it was 22% increase. You can see here in red that still persists. That's where you see this auto insurance component. So just a anecdotal comment that if your auto insurance goes up, has gone up, that's just the general nature of how things have happened over the past several months.
Mhm.
From a unemployment and wages perspective, um, wage growth is at 4% right here. So it's ticked down. This is in blue. So last quarter, when we looked at in February, it was at 4.5%. So it's moderated, falling a little bit, but just as to highlight, it's still above the rate of inflation of 3.3. So, you know, folks are not losing real wages in the sense that the wage growth remains higher than inflation, even though it has moderated a bit. And then the unemployment rate is right here. It's 4.1%. It's ticked up when we last reviewed these charts last quarter. It's ticked up about 0.2% since February. So still well below the historic 50-year average of unemployment rate of 6.2%. And just to highlight too, on the as far as the wage growth, it's approaching more of the normal level where we're at right now. And just to highlight also, obviously AI is always in a lot in the news nowadays. So as you can see, a lot of the CapEx spending, great increase this year. And these are from the hyperscalers. So that's the Microsoft, the Amazons, the Googles, the Metas. They've put a lot of CapEx in it, but one of the things that's coming about now, and here's some of the AI adopters, it's actually producing revenue. So it's not just putting money in, it's actually producing revenue for the companies that are the hyperscalers as well as the adopters. Folks are starting to use AI capabilities to their own benefit to help produce revenue. So that's all positive news. So the tech, all the tech gains and stuff and everything you hear in the news, it's actually less smoke, and it's actually turning into real revenue for companies, not only the hyperscalers but also the folks that adopt the new technology. So that said, Chris, I'll turn it over to you.
All right. Very good. So now we're going to cover what are the bad parts? What are the what are the parts of the apple that are not so crispy, so to speak. Okay, so there's a sort of separation within our country in the sense that wealthy people are doing well and are spending and there's no issues, and people who are in those sort of lower socioeconomic levels, they're having a bigger challenge. And you see that in this area with auto and credit cards. It's risen, specifically delinquencies. So you see those numbers here. And additionally, what we are expecting is for student loans to rise. There's been a lot of leeway in this area, and clearly you see the delinquencies are historically in a higher place. So we do anticipate this to come. Again, we will be hearing this on the news media, and it's not a surprise. So this is part of why we're hosting this event. This is a concern. People having defaults in their autos and credit cards, it's something that we're monitoring. It's something that we're aware of. Okay. Next is the federal debt. So our debt is roughly $35 trillion. What this chart is telling us from JP Morgan is that that amount of debt is essentially 100% of our economy, our what's called GDP. So our debt to GDP are essentially 100%, they're equal. And because we run a deficit, that number is going to grow. So in the next 10 years, without this is the tax Cuts and Jobs Act, which, depending on who becomes president, we'll see what happens with this. The Tax Cuts and Jobs Act is expected to end on December 31st of next year. If nothing happens with that, we're expecting the debt to GDP to go to 122% in the next 10 years. If it's extended, meaning the tax cuts are extended, it will grow as high as 133%. So there are strategies to decrease this. We're not getting into that on this call. It's just the data point of the debt is something that we focus on, and it's our job to break it down in a digestible way. And likely this will be something that we'll continue to talk about as we continue to host this event. Okay. Next is the deficit, is the spending. So this is our 2024 federal budget. So for this year, we're going to spend $6.8 trillion. So breaking down the spending, we've got Medicare and Medicaid at 25%, Social Security is at 21%. So between Medicare and Medicaid, we're already spending 46% of the budget. It's already baked into the cake. Then we have defense, which we'll talk about global turmoil in a little bit. It's 14%. Not going to spend any less there because the world's definitely become a more dangerous place. Non-defense spending at 13%. Net interest. So what does it cost to finance? What does it cost to finance all of this borrowing? Well, that's right here, 13%. We'll talk about this a little bit because we have another section to talk more specifically about the net interest and then other spending. Okay, so how do we fund this? Well, you've got personal income tax, so that generates 36%, corporate tax, Social Security, other is tariffs from other foreign governments. So that leaves, what are we financing? We're financing $1.9 billion. That's, this is our deficit spending. It's not good. It'd be better if we reduced some of this spending or increased tax revenue. So those are the levers. There are ways to solve this. Again, that's not part of our call today, but just letting you know, this is what the spending is and something that we monitor, and we'll continue to communicate this to you to show you and break it down. Okay, so what is the summary within the US? The good is GDP increased our growth. The growth of our country increased by 2.8% in the second quarter, and it actually increased our trend. So we're back to growing by more than we were at an annualized rate, which is not something you will typically hear from other sort of mainstream channels. Inflation declined in June. Interest rates are working, inflation is going down. All of these things are moving in the right direction. And wage growth, because the consumer drives 2/3 of our economy, the growth continues to outpace inflation. So that's all moving in the right direction. Okay, what's bad? Again, auto and credit card delinquencies are rising. Again, we expect student loan delinquencies to rise, debt to GDP at 100%, and our deficit spending at 1.9. So these are some of the areas that are not so good. And of course, we're monitoring that. Before I turn it over to Brian, I just want to remind each of you on the call, please put your questions in the Q&A. We're going to go through our pre-prepared comments here, but please put your comments in the Q&A. What are your questions? And I guess my encouragement is go for it. Put the question out there, because chances are someone else has a similar question. And once things get rolling in the Q&A, then we can go from there. But as we're talking about points, if you have a question or you want us to clarify after the fact, put it in the Q&A, and we're happy to come back to revisit anything that we discuss in the presentation or that's on your mind in general. Okay, Brian, let me turn this over to you.
All right, so transitioning out of the US. So first off, we'll look at international developed markets, and we'll look at some good points from that. So very much like the US, this is the CPI, this is the inflation index. Very much like the US, inflation has moderated or slightly decreased in some countries. So what I have highlighted here, highlighting in yellow, these are the other international developed market countries, excluding US, which is right here. What I did is this is the second quarter and this is the third quarter numbers. So you can see Japan stayed even as far as inflation. Canada up down ticked to 0.1. Eurozone stayed even. Same, Germany stayed around the same. France came down a good bit. United Kingdom came down, and then Italy stayed around the same. So overall, just like we're seeing in the US, there's a moderation of inflation in the international developed countries, or a slight downtick, just like we covered with respect to the US. From a wage growth perspective, Europe, the Eurozone is still on the uptrend. So this is slightly higher than we looked at last quarter. I think it's increased about 0.2% since the last time we reviewed this information. So once again, like the US, it's above the inflation rate. So that's a good thing. So real wages are positive in Europe, just like it is in the US. Now this trend has been going up, and we'll look and keep track of it, see if hopefully it starts to moderate a bit and doesn't cause any impact on the economies. And then unemployment. So what you will see here is in the dark blue is Eurozone unemployment rate, and in the light blue, which is maybe kind of hard to see, is Japan unemployment. These have both been really on the downtrend, or slightly moderating, evening out. So really no concerns. We don't see any spikes or anything. This is, of course, the COVID spike for all the countries, but from an unemployment rate perspective, there's no concerns from the developed markets. So that is all doing well. And then transitioning over. Chris, you want to cover the bad for us?
Okay, yeah. So these are the I mean these are the headlines that we're seeing, well, almost every day now, since over the last 5 days. Is just global conflict and war. So it started with Russia and Ukraine, and of course that's ongoing. And then in the fall of last year, October 7th, became between Hamas and Israel. And of course, over the last 5 days, it's gotten even more heightened with the attack in the Golan Heights in Israel, and then Israel's response with killing the leader of Hamas this morning in Iran, in Tehran, as well as killing the senior military leader of Hezbollah, which was 2 days ago, a day and a half ago, in Beirut, in Lebanon. So this is, there's going to be a response, and it's a major concern, but it's more humanitarian. It doesn't impact as much the economy, but it's a humanitarian issue. And so you'll see here, of course, the long-term trend is positive. Your accounts are going to grow long-term, but it causes consternation, and it's not good. War is not good, but at the same time, neither is terrorism. So it's we're living in a real historical time right now. So that's the bad, and that's not a surprise. Okay, So let me sum up here. The good parts about the international is that inflation continues to decline. And on top of that, just like the US, and interestingly, as Brian was pointing out, inflation in Europe is less than inflation in the US. So they're experiencing that to a lesser extent, and their wage growth continues to outpace inflation. And international wage growth, their wages are growing faster than US wages. So in many ways, the international picture is quite strong. Here again, unemployment in the Eurozone and Japan remains low and trending down. And then we didn't have a slide for this, but the valuations, when you look at the valuation, which is the price, that basically your purchase price, your entry point, is very attractive as it relates to the US. So this is why we hold international, and something that Brian and I look at on a regular basis. Here again on the bad side, ongoing and potential future impacts of Russia and Ukraine, Israel, Hamas, and could be added Hezbollah and Iran. So of course we're all looking and seeing what'll happen there. Okay, Brian, let me turn it back over to you.
Sure. So we'll continue in the international area, but we'll go into more of the emerging markets, which is like India, China, Taiwan, the Koreas, so forth. So one point to make is, and this really applies to all international, but we got a specific point on the emerging markets. So this graphic here looks at the top 50 performing companies, basically total return in US dollars globally. So internationally, you can see thus far in 2024, 40 of the top 50 top performing companies from a return perspective are outside the US. And this is one reason why we stay diversified, not only focus on the US, but also diversify into the international developed countries, as well as the emerging markets countries. And one interesting aspect of the emerging markets, as one reason why we have some invest in that area, as you can see here, this slither, this light blue slither here, for out of the 40 companies internationally, the predominant number of emerging markets have been the top performers thus far in 2024. So just kind of a reminder of why we stay diversified across the globe, not only just focus on the US. It's just lots of good, fast, good growing companies, good opportunities from an investment perspective outside of the US. This is a chart that we've looked at before. Some of the numbers have updated, so we're basically looking at 24 forecasts, but basically same story. India is really in the upward trend as far as their GDP growth year over year. So seen for this year as well as seen in 2029, out of all of the countries, they're going to continue to expand. Essentially, have kind of taken the place of China as far as from a GDP growth perspective. China, while they still have a good growth forecasted for 2024, you can see they're a little bit more on the downtrend, still above some of the developed countries over here, but they're a little bit on the downtrend, kind of reflecting kind of India's taking their place. And then the other emerging markets are really seen to be status quo as far as some good growth, GDP growth rate, but overall kind of maintaining at the same rate this year as well as 5 years out in 2029 based on their forecast. So from a bad perspective, so once again, the good performance, not internationally, all international developed, but also emerging markets. GDP growth remains great in the emerging markets. Bad is the ongoing, once again, kind of the other international theme is just ongoing global military and trade conflicts. So some of the emerging market countries are in that area of conflict. And then plus we've got the trade conflicts, the ongoing what tariffs will we'll have with China, what tariffs we'll have with them. So that will continue to persist on through this year, and of course, as we get into the new election cycle. So those are some of the uncertainty about emerging markets is what's going to happen in that area. But otherwise, it's all positive. So transition over here, and Chris, you want to
Yeah.
fix the count?
So fixed income is the more conservative part of our portfolio. And another way for saying this is our bonds. The bonds, and when you break down this word, meaning your income is fixed, it's the more conservative part of the portfolio. Okay, so what's good? As you see up in the top left here, this talks about the 25-year average valuation. So again, it's like your purchase price. It's like, how much are you buying it for? This is the range of all of the 25 years, and the green circle is currently where we are now. So in the bottom left, you have treasuries. Treasuries are US government bonds, as well as the next is US core bonds. So you can see the green diamond is where we were in the beginning of the year, and this is where we are in the middle of the year. So the prices have improved. They've fallen even more. So and this is an area that we've entered into, and I'll cover some more on this on the next slide. But what's important to know is that interest rates are going to go down in the next 12 months. And if you imagine a seesaw in your mind and interest rates going down, what happens is that bond values rise. So when you come in at a lower valuation and then interest rates go down, you get price appreciation. So I have a couple of slides to show you as well. But what's important here is our entry point. Is the entry point is attractive. And also it shares with you why we migrated out of CDs. So coming back to that seesaw, when interest rates were rising because of inflation, people who didn't do anything with their bonds saw their values decline. They saw negative returns in those bonds. So we knew that would happen, which is why we moved to CDs. CDs giving us that guaranteed fixed rate. Well, CD rates have peaked. They peaked in September of 2023. And what JP Morgan is highlighting for us is that after CD rates peak, and you look at a more traditional type of bond position, historically they do better. And this is what we're doing on your behalf. So you see, even since September, the more traditional bonds have returned 6%. And through all of these historical milestones, they've performed better, even modestly better, but long-term, they've performed better. So for now, a high-yield savings accounts remain competitive. They'll pay more than 5% on your cash, but a high-yield savings account's not necessarily an investment. It's more for your emergency fund. And so for people who are holding excess cash, our message to them is to move that towards your portfolio so that it can grow better towards whatever particular goal those funds are for. So the last piece to share within the bonds and within the more conservative nature, again, going back to the seesaw, when interest rates go down, bond values are going to rise. And this dark blue part of the chart shows you when interest rates are falling, what is the price appreciation that we can expect? And these are all the different components within the bonds themselves. So here's US aggregate bond, here's high yield, this is mortgage-backed securities, asset-backed securities. So there are a variety of different places within the bond market that you can buy, and these are government bonds. So 2-year US treasuries, 5-year treasuries, 10-year treasuries, all different areas. So this is something that Brian and I discuss on a regular basis and formulate the strategy for how are we going to implement this on behalf of the folks that we work for. Okay. What's bad? What's bad about the higher interest rates that we have within the bond market? And It's right here. It's the fact that we're running a deficit. So we talked about the fact that we've got a $1.9 trillion deficit. So that costs us more to finance. Think of this like your mortgage. People who are buying real estate now, they have to deal with the fact that interest rates are higher. So there's going to be a higher payment. But anyone who's buying real estate now, they know they're just going to refinance. They'll refinance in 2, 3 years, whatever that is. And when that time comes, the payment's going to go down. Our government debt is the same thing. And we refinanced during COVID. Interest rates came down, and we have our Federal Reserve. And what's unique about that is they can just buy back any bonds that are on the secondary market anytime, because we have our own treasury. And so, yes, we are paying more interest now. Think of it like getting a loan now, buying a house now. But in the next 2 to 3, 24, 36 months, as interest rates come down and the Federal Reserve refinances the government debt again, the net interest, the cost to borrow, will come down because interest rates will come down. Okay, so I'll wrap up the summary within the bonds. What's good? The valuations are very attractive. We started on the first slide there, and you can see the price is a good price. CD rates have peaked, and that's why we've migrated from CDs into the more traditional bonds, because what's going to happen next is that interest rates will be going down. Okay, declining interest rates, and in the future will provide an opportunity for price appreciation because interest rate declines. It's an inverse relationships. Think of that seesaw. Again, what's bad? Higher interest rates cost more for us to finance, and because we run a deficit. One additional comment, please put your questions in the Q&A. Let us know what's on your mind. We can clarify anything we reviewed. Anything else on your mind, please let us know. All right, having said that, Brian, let me turn it over to you.
Okay. So how are we applying this data on your behalf? So one thing to highlight here is, okay, so here is year-to-date return. This is as of June 30th, so end of last month. So as you can see here, large growth was just over 20% year-to-date return, where all the other asset classes in U.S. equity were all down in the single-digit range. So one of the things that we did at the end of June of this past year, we did a strategic rebalancing of all IRA accounts because of this outperformance in large growth. So basically, we took this advantage of selling high while large growth was at the double-digit 20% plus range for returns year to date, and we just distributed those gains down to some of the other asset classes. And that was done at the end of June. And one of the things I want to show you here is this is a chart from JP Morgan. They do this on a weekly basis. So one thing, so this is basically quarter to date, basically essentially July. So that's the third quarter. So as you can see, quarter to date, Russell 1000 growth, which is your large cap growth, has actually gone down 3%, while the Russell 2000, which is really a representation of small and mid cap stocks, has gone up 10.4. So this is some of the benefits. When we did the strategic rebalancing at the end of June, we're already seeing for July the benefits of that. So we basically took some from the high before this downtrend that happened in July so far, or at least through Monday this week, and we had distributed over to the small and mid caps, which month to date, as of this past Monday, we're gaining over 10%. So that strategic balance worked out well on your all's behalf to help realize some gains and then add to those gains as the small and mid cap area rallied in this month. Next slide. Okay, good. So as far as kind of summary, we're focused on fixed income, the conservative part of y'all's portfolio. We're remain focused on interest rates, duration, and inflation. And as Chris alluded, with the moving from CDs into bonds, we're actively managing duration as it relates to interest rates. So as interest rates start declining here in the next 12, 24 months, we'll be continue to actively manage, reviewing, meeting, and deciding if there's any adjustments we need to make to the conservative part of y'all's portfolio. And then from an equities perspective, as mentioned, we did the strategic rebalance at the end of June, and we'll continue to do very much the same thing. As more data comes out, we'll look at any other opportunities to rebalance or adjust the allocations. So right now, we're keeping the allocations maintained as they are, but as interest rates start to be decreased and other economic activity comes about, we'll continue to monitor and make adjustments as necessary.
Okay, this is my section here, leaving you with one last chart, which is in the food for thought category. So what you're seeing here are the two different parts of your portfolio. The growth side is the S&P 500. This dotted line says this is the last rate hike, and these are all of the historic ranges from the past, and in red is 22 to 2023. So this is where we are so far. And on the bottom, the months since the last hike. So it goes up to 2 years. So you'll see, okay, we're here about the middle. There are times where things ended more poorly, and there are times where it ended maybe modestly better or meaningfully better. So for example, up 20%, it could be up as high as 60% in the next, say, 18 months, and we could even see a downtrend. So this is a question mark. We're sharing with you the data. Speaking on behalf of Brian and myself, we think this is going to trend higher, specifically because of jobs, the number of jobs that are available, and the strength of most consumers. Yes, we saw some issues with some consumers in terms of the delinquency, but largely there are more people working and seeing wage growth. So they're very positive things within the economy. So we expect things to continue to grow. This part is the more conservative part of your portfolio. So it talks about the US 10-year, meaning the US 10-year Treasury, which is the bonds, the more conservative part. So again, we talked about interest rates going down. When you see this purple line, so what happened in 1983 and 1984? Interest rates went down. Interest rates went down meaningfully and rapidly. So that's why you see this shooting up here. And here's where we are so far in red. So meaning that interest rates have not declined as much so far in this recovery because of inflation. Inflation's been sticking around, and so the Federal Reserve has not declined interest rates. There's all this discussion around when are they going to do, when are they going to do. My hope is that they are not influenced by peer pressure, which I don't think they would be, but there's just a lot of talk about it. When are you going to lower interest rates? When are you going to lower interest rates? And it's like, lower interest rates when the time is right. So it's not now. And my hope is that it's not even in the fall, because it's actually harder to increase interest rates than it is to lower them. We are where we are now. Things are growing. Jobs are good. Things are good about the economy. We don't need to preempt something by lowering interest rates. So they will go down in the next 12 to 24 months, and we will see something like this. I'm just hoping that they do it when the time is right, and I think they will. Okay, that is we went a little longer in terms of our pre-prepared comments. Now we're migrating into the Q&A section, and so let me bring this up. I see we have one question so far. Do we expect to have additional swings in interest rates with the uncertainty of the upcoming election, or do we foresee a reduction in the long term? So I'll jump in here. we expect a decline in interest rates, not necessarily with the election itself. There would be, maybe volatility within the stock market, within the equities, which is not a concern. It's just, greater fluctuations based on the unknown, which is really where that comes from. So interest rates will be, and by design, we want folks to think in the 12 to 24 month time frame. So over the next 12 to 24 months, even 12 months, interest rates will go down. That I feel comfortable saying. Now, whether it, 1 month, 3 months, 9 months, who knows? But long term, interest rates will be going down. Having said that, Brian, let me turn it over to you to get your input on this. What are your thoughts about the question?
Yeah, no, I agree. I mean, and the Fed, the Fed is supposed to be politically neutral, which I believe this Fed is. So if there is any decrease in the Fed rates come September or later this year, it's really going to be independent of what happens from a political standpoint. I think they remain focused on the economic data and kind of stay clear of the political noise, so to speak, as far as what's happening there, and try not to jump the gun on who might get elected president, House, Congress, and what may happen from a policy perspective. They're dealing with what's here and now from an economics perspective, and making the right decision as they see fit. So
And additionally, in everyone attending this call has received an invitation to our Zoom, which is going to be on Thursday, September 5th. So we have a very sort of narrow presentation about the election and some data points that you can see for yourself, and have a conversation around what to expect as it relates to the election. Again, please put your questions out there. If you have a question, likely someone else does too. So feel free to put it out there. You don't need to put your name. You can ask as an anonymous person. While I give a few minutes, I thought I would take a moment to comment further about the word duration. Brian and I try and are very deliberate about not using jargon, the industry terms that you see on CNBC, because it's just weird. People, I don't know why people talk that way. It's not how normal people talk, but that's how people talk on TV, I guess, for some reason. Duration is the length of time that you choose to have your bond or CD. CD is a form of lending. So you go to the bank, you lend the bank, you give them a loan, and they give you a particular interest rate. You can give them a loan for a duration of 3 years, a duration of 5 years, or longer. So duration equals the number in terms of years. This is giving an example of rising interest rates, which we already have. So people who have a longer duration, when interest rates are rising, they actually lose even more, or they see their values decline by more, which is why we bought CDs again when interest rates were rising. Well, now we're going to see the opposite effect. So interest rates are going to be going down. This seesaw is going to be going in this direction. So when we use the term duration in terms of what Brian and I are doing behind the scenes, so to speak, it's where do we sit on the seesaw? And so that's something that we are very actively monitor, and do that on your behalf. Okay, we can give it another minute or two for people to ask questions. But if we don't get any additional questions, feel free to email us, reach out to us, let us know what's on your mind. And again, we host this event on the final Wednesday of each new quarter, and that's by design. It's by design because we want to give it more time for data to come out. We attend a lot of these calls on a regular basis because we're getting the input from JP Morgan and Fidelity and a variety of other sources So for example, earlier this month, we didn't know what the GDP or the growth was in the second quarter. Well, come to find out, it's 2.8%, and we're actually growing by more than we were as of the first quarter of the year. So again, it's very deliberate that we host this at the end of this month, because it allows us to speak more accurately and not just make some here's what we think is going to happen kind of situation. So all right, looks like we are out of questions for now. So let us know if we can help further, and we are looking forward to a strong second half of 2024. Have a great day, everybody. Thank you for your time and attention. Bye-bye.